The economy wasn't created to make money. The economy was created to add value to the collective. So you can say that the world is in need of some serious shifting. And since you're watching this video, you're probably aware of this too. And you recognize the need for change. This is a story about choice. And this might be a story about your future plans. Impact investing. According to research by the Financial Times, the amount of capital invested in impact has doubled over the last 5 years. But what is it exactly? The most accepted definition for impact investing is investing with the specific objective of achieving positive social and/or environmental impact as well as financial return. So a positive impact and financial return. Just to make you a bit more familiar with the term, let's place it on a scale with other sorts of investments. On the right, you see traditional investing. This is what we call investing for the sole purpose of financial return, with no impact objectives. With responsible investing, we filter out harmful investments like weapons or tobacco, for example. When you're into sustainable investing, you invest in companies that take into account environmental, social, and governance criteria. Think water and energy efficiency. Or an apparel company with strong policies protecting fair labour conditions, still with a focus on the financial side of the investments. Starting here, the philosophy behind the investment slowly moves from do no harm to intentionally do good, which is the essence of impact investing. But before we dive into this, let's finish telling you what it's not. With venture philanthropy, you invest in social purpose organisations, taking high financial risks in order to drive the organisation's impact. Traditional philanthropy is grant-based funding of social purpose organisations, often simply donating money to create maximum impact. Now, impact investing. Impact investing is not an asset class. It is an investment approach across all asset classes, themes and geographies, and has a full range of risks and returns. For example, impact investments can range from a direct private equity investment in a fintech company providing access to finance to underserved populations, to a loan supporting sustainable agricultural business, or from a note subscription in a renewable energy fund to a share purchase in a sustainable forestry fund. As we said, it's about intentional impact and financial returns. When looking at the impact side, one can ask, what's your taste of good? Where do you want to create impact? This can be in services or in products provided, such as building solar-powered lamps for developing regions, developing natural washing products, or producing healthy foods. Impact can also be made in the way businesses are run, or even on multiple levels, such as safeguarding the mining of fair raw materials, honest working conditions, waste management, or offering jobs to those who have less opportunities. Such front-runner companies aim to change the entire industry they work in. Financial profit can be made in countless proven and unproven business cases. So, as with traditional investing, deciding which business models have potential is art, science, and all the fun of investing at the same time. When considering to start impact investing, there are a few things we can advise. Decide on what you care about and what your strategy is to approach this. Carve out some funds to experiment and learn from experienced peers, professionals, and intermediaries. Then, just get started. Don't wait. Environmental challenges and social structures need attention now more than ever. So consider that you're doing this for the generations to come. Like we said, this is a story about choice. You can choose where your money creates the impact we need for tomorrow's world.